Picture two friends sitting at the same kitchen table in the same year with the exact same amount of money, $50,000 each, same starting line, same savings discipline to get there, and they are both about to invest every dollar of it. The first one, let us call him Derek, buys a rental property, a $250,000 single-family home in a decent neighborhood. He puts his $50,000 down and gets a mortgage for the rest. 2 weeks later, he is texting his friends about it. He is doing the math on a napkin at dinner. He's talking about cash flow and equity and landlord life. He has a story to tell and people are listening. He feels like he figured something out that most people around him have not. The second one, let us call her Priya, opens a brokerage account, puts all $50,000 into a total stock market index fund, sets up a $300 automatic monthly contribution and closes the app. She tells nobody. There is no story to tell. There is a confirmation email and a small green number on a screen. That is it. Now here is what I want you to hold on to for the next 20 minutes. At the end of year 1, Derek is going to feel like a genius. At the end of year 5, Derek is going to feel like a professional. And somewhere around year 12, Priya is going to quietly pass him, not dramatically, not with a big announcement. Just a number on a screen that, when Derek finally sees it compared to his own, is going to hit him somewhere between surprised and gut-wrenching. The gap between them at year 20 is the number this whole video is building toward. And it is not the number most people expect from either direction. If this is your first time here, subscribe right now because this is exactly the kind of video this channel was built for. No hype, no agenda, just the real math on both sides of a debate that the internet gets wrong constantly. I am David Marshall and let us run the actual numbers. Let us start with Derek because Derek has the better story, and in personal finance, the better story almost always obscures the better math. Derek buys a $250,000 house with his $50,000 down payment and a 30-year mortgage at 7% interest. His monthly mortgage payment is approximately $1,330. He finds a tenant who pays $1,800 a month in rent. Derek does the math on a napkin and it looks like this. $1,800 in, $1,330 out, that is $470 a month in profit times 12 months. That is $5,640 per year on a $50,000 investment. Derek has convinced himself he is running an 11% annual return before he has even cashed a single check. He is feeling very, very good about this decision. And here is the part of the story where I need to pause because this is exactly where most real estate conversations stop. The math on a napkin, the gross number. The headline figure that sounds compelling at a dinner table and gets repeated on social media and becomes the basis of an entire worldview about why real estate is the best investment in the world. The problem with math on a napkin is everything that math on a napkin leaves off the napkin. Vacancy, the industry standard vacancy rate for a residential rental property is somewhere between 5 and 10% annually. That means in a typical year, Derek should expect the property to sit empty for roughly 4 to 6 weeks. At $1,800 a month, that is somewhere between $720 and $1,080 in lost income per year. Not because Derek is a bad landlord, not because the neighborhood is bad. Because this is simply what happens with rental properties over time. Tenants move. And there is always a gap between one tenant leaving and the next one being approved and moving in. Then there is CapEx, capital expenditures. The big-ticket items that every property will eventually need and that most napkin projections treat as optional. The roof, the HVAC system, the water heater, the flooring after a long-term tenant moves out, the appliances. Financial analysts who specialize in rental properties typically recommend budgeting between 5 and 10% of annual rent for CapEx reserves. On a property bringing in $1,800 a month, that is another $1,080 to $2,160 per year that should be sitting in a reserve account rather than going into Derek's pocket. And then maintenance, the smaller stuff, plumbing calls, electrical issues, doors that stick, windows that need sealing, gutters that need clearing. HVAC filters and pest control, and the occasional after-hours emergency that costs triple because it is Sunday night and the only plumber available charges emergency rates. Maintenance on a residential rental property typically runs between 1 and 2% of the property value annually. On a $250,000 home, that is $2,500 to $5,000 per year. Added up, vacancy, CapEx reserve, and maintenance together eat somewhere between $4,300 and $8,240 per year from Derek's $5,640 gross profit. In a good year, Derek might net $2,000. In a bad year, meaning the year the water heater dies and a tenant breaks a lease early and the HVAC needs a compressor, Derek might net nothing. he might actually go negative. This is the moment where the math on a napkin meets reality. And reality does not care how optimistic the napkin was. Most people do not realize that the number landlords quote at dinner parties is always the gross number. The number they would rather not discuss publicly is the net number after you subtract the real costs that every rental property produces every single year without exception. Now, before I let Derek's situation sound hopeless, I want to be completely clear about something because this video is not a hit piece on real estate, and anyone who tells you real estate is always bad is not running the actual numbers either. There are things Derek has that Priya does not, things that matter enormously in the long run, and we are going to get to all of them. But first, let me show you what Priya is doing while Derek is fielding a call at 2 a.m. because a pipe burst in the upstairs bathroom, and the tenant is texting him photos of water coming through the kitchen ceiling. Priya is asleep. And this 2 a.m. call is not a hypothetical. It is not a worst-case scenario built to scare you away from real estate. It is the statistical reality of owning residential property. Major plumbing events happen, HVAC units fail on the coldest weekend of the year, water heaters rupture, roofs develop leaks during rainstorms, and they do not fail on Tuesday morning at 9 a.m. when Derek is well rested and has time to handle it. They fail at inconvenient moments because nature does not care about Derek's schedule. The 2 a.m. call is the symbol for everything about real estate that math on a napkin does not capture. The interrupted sleep. The emergency contractor rates that are 40% higher than normal because it is after hours. The stress of trying to manage a crisis remotely. The emotional labor of being responsible for someone else's home. This is the hidden cost of real estate that never appears on the napkin. And it is the cost that Derek will pay every single year for as long as he owns the property. Priya put $50,000 into a total stock market index fund and set up a $300 monthly automatic contribution. She has not opened the brokerage app in 3 weeks. The market went up 1.4% last Tuesday, and Priya has no idea because she was watching a show and going to bed at a reasonable hour. Her account is doing exactly one thing, compounding. In year one, Priya's $50,000 at the historical average return of approximately 10% for a total stock market index fund grows to about $55,000 plus her $3,600 in contributions, landing her around $59,000. Not exciting, no story to tell. Just a green number getting slightly less small on a screen she barely checks. Year 2, same thing, the number grows. She adds her monthly contributions, the account compounds, no phone calls, no emergency repairs, no negotiations with tenants, no vacancies, just gains on her gains, quietly accumulating in the background of her actual life. Here is what most people do not understand about compound growth and why the early years feel so anticlimactic. In the first 5 years, the numbers are genuinely not impressive. They do not feel like proof that the strategy is working. Priya's account after 5 years of 10% average annual growth plus her $300 monthly contributions is sitting somewhere around $115,000. That is solid, that is real money, but it does not feel like the wealth transformation she signed up for. It feels incremental. And this is the exact moment when a lot of people who started where Priya started make a different decision. They see the number and feel underwhelmed and start wondering if they should be doing something more interesting with their money. The ones who stay patient are about to experience something that looks from the outside like overnight success, but is actually just compounding doing what compounding does when you finally give it enough room to breathe. Because here is where Priya's story changes. Year 10, Priya's account, assuming consistent 10% average annual returns and her $300 monthly contribution, is approaching $230,000. Now the absolute gains per year are starting to look different. A 10% return on $230,000 is $23,000 in a single year without Priya lifting a finger. Gains on her previous gains. The engine that seemed boring and slow in year 3 is now generating more wealth in 1 year than most Americans save in 5. Year 15. Priya's account is approaching $430,000. A 10% year from this base generates $43,000 in returns in 1 year automatically, while Priya is living her life. Year 20, this is the number this entire video has been building toward. Priya's account at year 20 with consistent contributions and historical average returns for a total stock market index fund lands somewhere around $780,000 to $820,000. $3.25 million, built by starting with $50,000 and adding $300 a month and doing nothing else. Absolutely nothing else. Now let us go back to Derek for the 20-year check-in. And I want to be fair to Derek because real estate has something that Priya's index fund does not, and it is one of the most powerful forces in personal wealth building that exists. Derek used his $50,000 to control $250,000 in assets. That is 5-to-1 leverage. And leverage is the reason real estate has created more American millionaires than probably any other single asset class in history. But before we get to Derek's 20-year numbers, I want to do something that almost nobody does in these comparisons. I want to run the sweat equity audit, because Derek's real estate investment is not passive income in the way the phrase implies. It is a business. A small business that Derek is operating alongside his day job, his family, and his actual life. Conservative estimates from property management professionals suggest that a self-managed single-family rental property requires somewhere between 5 and 10 hours per month of active time in a normal month. Tenant communication, maintenance coordination, rent collection, financial tracking, lease renewals, that is 60 to 120 hours per year in a quiet year. Over 20 years, that is somewhere between 1,200 and 2,400 hours of Derek's time. Hours he could have spent on his career, his family, his health, or literally anything else. And in the bad years, the years with tenant turnover, major repairs, eviction proceedings, or property damage disputes, that monthly average spikes dramatically. A single eviction process in most American states takes 3 to 6 months and dozens of hours of documentation, court appearances, and coordination with attorneys. Priya's sweat equity over the same 20 years, approximately 0 hours. She set up an automatic investment. She occasionally logged in to look at a number. She did nothing else. The total stock market index fund did not require her time. It required only her money and her patience. One worked for it, one waited for it. Here is what Derek's 20-year picture looks like. A $250,000 home appreciating at the historical average of roughly 3.5 to 4% per year is worth approximately $480,000 to $500,000 after 20 years. Derek's remaining mortgage balance after 20 years of payments on a 30-year loan is roughly $155,000. Derek's equity in the property is therefore somewhere between $325,000 and $345,000, plus whatever net cash flow he accumulated over 20 years after the real costs were subtracted. Even conservatively adding $30,000 to $40,000 in net cash flow over the full 20 years, Derek is looking at a total position somewhere in the range of $360,000 to $385,000. Priya, $780,000 to $820,000. Derek, $360,000 to $385,000. The gap is roughly $400,000 at year 20, on the same starting amount, on the same monthly contribution. The person who did absolutely nothing except not panic and not sell is significantly ahead of the person who learned a new skill, managed tenants, took midnight emergency calls, tracked expenses, and worked actively for 2 decades. One worked for it, one waited for it, and the one who waited came out dramatically ahead. But I said I was going to be fair to Derek, and I meant it, because this comparison has a real asterisk and the asterisk matters. The most gut-wrenching moments in Priya's 20-year journey are the ones that the clean historical average numbers do not fully communicate. In 2008, Priya's account dropped more than 50%. If she started investing in 2004, her account looks like it is being destroyed in 2008 and 2009. Every instinct she has tells her to sell, to stop the bleeding, to get out before it gets worse. This is the moment that ends a lot of people's index fund investing journeys. This is panic selling, and it is the single biggest risk in Priya's strategy, not market volatility itself, but the human response to market volatility. The investors who sold in March 2009 locked in catastrophic losses at the worst possible time. The investors who held and kept contributing captured one of the greatest recoveries in stock market history. The difference between those two groups was not intelligence or financial sophistication. It was the ability to do nothing when everything in your brain is screaming at you to do something. In 2020, Priya's account dropped 34% in 33 days. Gut-wrenching does not fully describe what that felt like in real time. And again, the difference between the investors who came out ahead and the investors who did not was largely about who panicked sold and who did not. Derek did not have this problem in the same way. His house did not flash a number at him every morning. He could not see the market value of his property updating in real time during a crisis. The illiquidity of real estate that seems like a disadvantage is also a psychological protection. It is genuinely difficult to panic sell a house. This is a real advantage Derek has, and it deserves to be named honestly. Let me also name Derek's tax advantages because they are substantial and ignoring them would make this analysis incomplete. Derek can depreciate his rental property over 27.5 years, meaning he can deduct roughly $9,090 per year from his taxable income even in years when the property is appreciating in value. This is a legal tax shelter with genuine dollar value, particularly for someone in a higher tax bracket. And if Derek decides to sell the property at year 20, he can use a 1031 exchange to roll his gains into another investment property without paying capital gains tax on the appreciation, deferring that tax bill potentially indefinitely. These tools are not available to PREA in the same form, and they represent one of the strongest legitimate arguments for real estate as a long-term wealth vehicle. The tax magic of depreciation and the 1031 exchange are two of the reasons that the wealthiest real estate investors consistently outperform the napkin math version of what real estate looks like to a new investor. Not because the properties perform dramatically better, but because the tax treatment of real estate income and gains is more favorable than most people realize until they are deep enough in the numbers to see it. So let me give you the honest answer that this entire video has been building toward, not a winner, a framework. Real estate wins when Derek is house hacking, meaning he is living in one unit of a multifamily property and having his tenants pay his mortgage, dramatically changing the effective return on his investment. Real estate wins when the rent-to-price ratio is above 1%, meaning a $250,000 property should rent for at least $2,500 per month for the numbers to work cleanly in the landlord's favor. Real estate wins when Derek is sophisticated enough to execute 1031 exchanges and leverage the depreciation deduction strategically over time. Real estate wins when Derek is in a high appreciation market where property values are compounding faster than the national average. Index fund investing wins when the investor can automate it completely and leave it alone through the gut-wrenching years. Index fund investing wins when the investor genuinely does not have the time, expertise, or temperament to manage a property actively. Index fund investing wins for diversification, since PREA's $780,000 is spread across thousands of companies in the total stock market rather than concentrated in a single asset in a single location. And index fund investing wins on the sweat equity audit, the calculation that almost nobody does before choosing real estate, because the hours Derek spent managing his rental property over 20 years represent a real cost, even if they do not show up in any financial statement. The comparison is not real estate versus index funds. The real question is which vehicle you will actually operate well given your specific temperament, time availability, tax situation, and local market conditions. The best investment is almost always the one you will actually stay in long enough for the compounding to work. Before I close this video, I want to say what I say at the end of every video on this channel, because I think it is the truest frame for why any of this matters. Money is not the goal. Money is oxygen. PREA did not build $780,000 in 20 years because she's smarter than Derek or luckier than Derek. She built it because she understood that the point of wealth is to create the freedom to live without constantly trading hours for survival. Every dollar in her account is working independently of how she feels on a given morning, independently of whether the market had a good week, and independently of whether a tenant called at 2 a.m. Building your oxygen supply means building systems that keep producing even when you step away from them, even when you go to sleep, even when life requires your full attention for things that have nothing to do with money. Run the actual numbers on both sides with all the costs included, then choose the path you will actually stay on. Because the investor who stays wins almost every time over the investor who starts with the better strategy, but quits when it gets uncomfortable. If this video gave you a clearer picture of a debate you've been trying to think through, share it with one person who is sitting at the same crossroads right now. And if you are not subscribed yet, do it now because next week we go inside the actual math of house hacking and whether the numbers make it the real estate strategy that finally beats the index fund on a fair playing field. I'm David Marshall. I will see you then.